Duncan, first, I think the big question is what happened today with the sell-off?
Well, that's a pretty broad question, but I think you saw exacerbated volatility largely due to the market structure. I think there was a lot of selling around the Greece issue, but I think the market went down a lot more than it otherwise would have were it not for some of the market structure inefficiencies.
Talk about the market structure and efficiencies because as we spoke before, you talked about slowed trades on this exchange and not others. It's complex, but it's important to this.
And it's going to sound very technical, but we have a different market model than everybody else. We trade as fast as they do when we think it's appropriate, but when there's very high volatility like there is today, we have it in our market model to basically slow the market down and take 30 or 60 seconds sometimes to find the right price for a stock. And today was, because of the volatility today, that trigger kicked in a lot of stocks. So what happened?
Is that automatic or is that a decision made by the people here?
It depends on the movement. It's stock by stock. You know how many, it's basically tied to the stock price in every stock. And if a stock moves down X amount at one time, we say, wait a minute, let's find the right price. So we slow
What
down.
happened? We're talking about Procter & Gamble, 3M, Accenture, major stocks here that were slowed.
Right, so those are three examples, and it's part of our model. So please don't say slowed like that's a bad thing. We actually think it's good for the issuers and investors. We think people are nervous. We disseminate to the rest of the markets that the next trade in these stocks is not going to be a millisecond from now. It's going to be 30 or 60 seconds from now. The rest of the markets are free to trade around us, through us, with us, anywhere they want, and that's what they did today. Now, it turns out we opened Procter & Gamble a minute later at roughly the same price we traded it at the last time. The other markets have sold it down, in that case, 20 or 30% of the interim.
The NASDAQ issued a statement saying that there was a faulty trade, there was an error made. What does that mean for the average person?
I think what happens is, I don't know that it's a faulty trade the way everyone would think about it. I think everyone's looking for the smoking gun saying, what trader made a mistake? Who had a fat finger and sold something they didn't mean to sell? My view is that's not what happened. What happens in these periods is, in a day like today, it may just take a few offers of people selling. They put in a market sell order. They think they're going to get filled near the price. And because the other electronic markets are thinly traded, the next price may be down $5, $10, $15, and that's how things trade. So I think you'll see NASDAQ and other electronic markets, including Archipelago, take trades off the tape later as erroneous.
What was it like on the way up? Because the market was off nearly 1,000 points. It closed down just 347. I say just because that is quite a phenomenal recovery.
Right, but if you think about it, the market was down about 400 before we went into the slow mode on M and P&G and Accenture and others. And I think a lot of that move from 500 to down 1,000 was people seeing these stocks trade at strange prices, getting a little nervous, and you saw it snap back right away. There was not a lot of volume on the way down or, frankly, on the way back up. And it doesn't surprise me that the market ended up closing down about 400. That's kind of where we were before we had the knock-on effects of us saying, hey, we're going to slow down for a minute. We recommend to the other markets, don't trade through us during that time, and they did.
I was just going to ask you that. Should this teach us that maybe all of the marketplace should be connected in order to all slow their trades at the same time? Because you said we halted our trades for a while and others traded through us.
Right. And remember, a while, I don't like to use the word halt because halt means something else technically in the market, okay? Halt means you may not open for an hour. Right. This is part of our market model. We intervene human judgment. We do price discovery. It takes 30 to 60 seconds. It doesn't take forever. And we think the markets should wait. They obviously think for competitive reasons they shouldn't have to wait, and they are going to trade at whatever prices they want to trade at in the interim.
The big question is how much money was lost as a result of this today. The market closed down near the lows of where it was before the sell-off, but what kind of damage could this do to investors?
Well, it's hard to know because we don't know how many trades. A lot of times what happens is these trades will be canceled. People will say, oh, we didn't realize what was going on. The fact is these electronic markets realize full well what's going on. They have policies to deal with these kind of things. The last time this happened frequently was during the crisis, where there were thousands of trades canceled on a daily basis at the electronic venues because it's a different market model.
Who or what, if anything, should or can be held liable? You said it's a different market model. It's what the traders told me. This is the new marketplace.
Right. And in our view, we think we've got the best market model. No surprise that we're going to say that, right? Others think they have a better market model. I think in periods of volatility like this, I think our model shows its value. A computer just looks for the next price that it can fill its order at. So if you put a market sell order in, and I'm the only bidder on that electronic system, your order is getting filled wherever my bid is. It could be $10, $20, $30 below the market price. And I think we just have to say in periods of extreme volatility, people should trade their orders more carefully. Now, the SEC could come out and say, hey guys, wait a minute. If it's a trading halt, we get that you're not going to wait. If it's one of these situations where it's a half a minute or a minute, why don't we all wait and let cooler heads prevail?
The volatility may be over for the day. Asian markets will open shortly. European markets, this marketplace will open on Friday morning. And heading into the weekend, the big question is, will traders want to hold their positions with the volatility, with the crisis in Greece and Europe? The question is, Duncan, what do you do going into tomorrow?
Right. I mean, I'm not a trader anymore. I'm just a guy running a business. But I think the view is, coming into a Friday after the week of volatility we've had, it's hard to believe people will come in with bids tomorrow. But the market has sold off quite a bit here. And I think people are just trying to digest how big an issue is Greece. What is the contagion effect? You had a couple of people say today there's going to be knock-on effects where the credit market seems to be seizing up. That's going to make people really, really nervous, especially on a Friday in front of a weekend.
It's a big question. Again, as I've been saying all afternoon, what happens going into tomorrow?
Yeah, hard to predict. We'll find out tomorrow. I mean, that makes a market, right? So, okay.